How to invest in a private equity firm. Most people think that private equity is only available to Wall Street insiders. The reality is, everyday investors can invest in private equity too. In this video, I'm going to show you how. Want access to exclusive high return investments not found on the stock market? Private equity firms offer some of the best opportunities. But here's what you need to know so you invest in them the right way. If you've ever wondered how to invest in private equity firms and get exposure to billion-dollar deals, then stick around. I'll show you the different options, the risks involved, and the potential returns you can make in private equity. By the end of this video, you'll know how to invest into a private equity firm, what your options are based on your investment level, and how to evaluate the best opportunities. So what is a private equity firm and how does it work? Private equity companies invest in private businesses, in real estate, in alternative assets, and they're here to create value and generate higher returns. They typically raise capital from limited partners or private investors and use that capital to acquire businesses, real estate, and alternative assets where they can generate higher returns. Unlike public stocks, these investments are illiquid, hands-on, and typically very long-term, at least 5 to 10 years. So how can you invest in a private equity firm? Here are some private equity firm options that invest in alternative assets. I'm going to break down the investment method of investing in a private equity firm, what type of investor it's for, and then what are the pros and cons. So first, publicly traded private equity stocks. Examples, Blackstone, KKR, Apollo. These investments are for retail investors and anyone with a brokerage account at an investment bank. The pros are there's high liquidity and no accreditation requirement. The cons are lower returns than direct private equity investments. Next, private equity funds. Patriot Fund 5 is an example of this, but there's other real estate syndication and venture capital firms out there. These are only for accredited investors and the minimum investment is $50,000 with most of these funds. The pros are higher returns than market returns and direct asset ownership, meaning that you are an owner of the actual asset that the fund owns. The cons are longer lockup periods, typically 5 to 10 years, and limited liquidity. Direct investment in a private equity firm, meaning a co-investment or LP status. Next one is direct investment in a private equity firm, sometimes called co-investment. These are for high net worth individuals, a minimum of $250,000, but many times it's $1 million or more. The pros are access to exclusive deals and control over the capital allocation. The cons are it requires a high level of capital to invest in, and they also require a heavy need for due diligence. Some examples of co-investment are with Blackstone and with BlackRock. Investing in publicly traded private equity company stocks. You can start with $100 or more to buy into their company. This is the easiest way to gain exposure to a private equity firm. Private equity giants like Blackstone, symbol BX, KKR, and Apollo Global Management are all publicly traded. You can buy a share of their stock if you like their investment plan. The pros are there's liquidity. You can buy and sell the stock at any given moment. Also, you get exposure to private markets without the long lockup periods of a traditional private equity fund. The cons are your investment is correlated to the stock market, so you don't get the advantage of buying into private deals because the returns are highly correlated to the stock market performance. Also, a con is you don't get direct access to ownership of the assets. You are just getting a piece of the private equity firm. So you don't own a piece of the assets in this model. Investing in private equity funds, $50,000 to $250,000 plus investment. Potentially higher returns, but longer investment commitments. Many private equity firms raise capital through funds, meaning pooled investment vehicles. These pooled funds take limited partners' capital and use them to go out and deploy or acquire multiple deals with that capital. Example, real estate private equity funds. Like Patriot Fund 5, we pool together investors' capital, and there's many other private equity funds that allocate capital to real estate investments. The vehicle that they invest in can go anywhere from apartments, industrial, retail, office, self-storage, mobile home communities, car washes, any type of commercial real estate that you know of would be an option for investors to invest in through a private equity fund. Venture capital funds. These typically buy smaller startup companies or larger established tech companies. Some of these funds are on angel lists. Also, Sequoia is one of the larger venture capital funds out there, and they do focus on these early stage startups. Leverage buyout funds or LBO funds. Blackstone, Carlyle Group, TPG, these are all LBO funds. And what that means is they are using debt to go acquire companies. That's a leverage buyout of a company. It's just a fancy way of saying they're using debt to acquire more companies under their portfolio or their fund. These various private equity funds have potential for higher returns, traditionally 14 to 18% annualized, versus 8 to 10% in the public stock market. These private equity funds offer tax advantages where there are vehicles to 1031 an investment into one of the funds or the partnership deals. Also, you are able to use depreciation on the distributions that you take and use those losses to accelerate your returns. The big downside is the time commitment of the investment. It is a 5 to 10 year commitment with these private equity investment models. And these types of funds are limited to accredited investors. You need to have a net worth of at least $1 million, excluding your equity in your home, or a salary of $200,000 per year as a single person, or $300,000 a year as a married couple for at least the last 2 years. These accredited investor requirements are essential where you are unable to invest unless you meet those requirements. Co-investing or directly partnering with a private equity firm. This investment requires at least $250,000, but many times $1 million or more to be able to co-invest with a private equity firm. These are typically for only ultra high wealth individuals. Blackstone is famous for allowing some of their limited partners to co-invest with the general partnership alongside with them with a high amount of investment. The pros are you get direct ownership and a strategic level of involvement in high-level deals. These deals can be very complicated, so they require a high level of due diligence and oversight of management and deal structure. Like I said, these are high investment minimums. $250,000, but really $1 million or more is required to even play at all in this arena. So how do you get started investing in a private equity firm? Here's the action plan. Number 1, determine your investment level. Do you want to look at stocks? Do you want to look at private equity firms? Are you looking at co-investing with a private equity firm? So step 2, you want to research these firms. Look at their track record. What's their investment strategy? What fees are they charging? And what's their past performance? Step 3, if investing in funds, vet the sponsor. Do they have skin in the game? Did they put up their hard-earned money alongside you as an investor? Step 4, start small, diversify, and ensure your risk tolerance matches the investment that you're investing in. You know how to invest in a private equity firm, but it's important you analyze the investments that are going into the fund or the partnership. In this next video, I'm going to show you how to analyze businesses or real estate that are going to be going into these private equity funds. Click the link in the description and I will show you how to analyze these investments so you can invest like a private equity pro.